For producers watching margins tighten, today's market picture looks calm, but calm markets can hide pressure. Corn, soybeans, and wheat are steady, cattle are mixed, and crude is holding. Yet the real risk hasn't disappeared. If you're making feed, pricing, or risk decisions right now, this matters. The question this morning isn't whether markets look stable, it's whether stability is quietly setting up the next squeeze. Good morning, this is Boots and Bushels, your daily look at the markets that move your farm and ranch. We're mapping today's risk picture using where futures were trading late in Tuesday's session as our guide. As always, this is about awareness, not advice, helping you spot pressure points so you can make decisions with your own numbers in mind. Today's map centers on three themes: grains trying to stabilize, livestock sending mixed signals, and crude holding steady enough to keep cost pressure in play. Corn is trading near 438 on the May contract. That level looks steady on the surface, but steady at this price keeps margins tight for many operations. The key pressure point is demand. If consumption holds, corn can stay supported. If demand weakens, even slightly, prices can soften quickly and shift break-even math at the farm gate. Stability here isn't comfort, it's balance on a narrow edge. Soybeans are trading near 1155. Beans have found footing, but demand remains the main driver. Strong demand supports prices. Weak demand introduces pressure fast, especially as planting decisions approach. For producers weighing forward pricing versus patience, this range forces deal decisions rather than offering clear direction. Chicago wheat is trading near the mid-570s. Wheat continues searching for conviction, reacting more to global signals than domestic momentum. Weather, exports, and currency movement remain key drivers. When wheat shifts without strong direction, markets are waiting for the next supply or demand signal, and those signals can shift quickly. Oats remain lightly traded, but continue reflecting broader feed grain conditions. When feed demand tightens, oats follow. Quiet markets don't mean irrelevant markets, especially when feed cost matters to the operation. The grain pressure point, the risk isn't volatility, it's tight stability. Sideways markets can quietly squeeze margins without dramatic moves. Live cattle are trading near $239.17, slightly softer. Even small weakness matters at high price levels. Tight supply continues supporting cattle overall, but elevated prices reduce tolerance for negative surprises. For producers, the key question is timing. When strength holds versus when protection becomes necessary. Feeder cattle are trading near $358.52, holding firm. Feed cost expectations and placement decisions remain central drivers. Stable feeders signal confidence, but that confidence depends heavily on feed and fat cattle direction. This remains a watch area for margin planning. Lean hogs are trading near 95.80, showing strength. Demand and supply expectations continue guiding hog direction. Hog markets can turn quickly when sentiment shifts, making risk timing critical for producers balancing feed cost and hog values. The livestock pressure point, no collapse, uncertainty. Mixed signals require decision timing rather than offering clarity. Crude oil is trading near 65.99, holding steady. Stability prevents sudden jumps in fuel and input costs, but this level still maintains pressure on operating expenses. If crude drifts higher, cost pressure increases. If it weakens, margin relief improves slightly. Energy remains a quiet but constant factor in farm profitability. An energy pressure point, no price spikes, persistent cost pressure. Weather remains a background factor, but markets often move before weather becomes obvious. Soil moisture, early season outlook, and planting expectations shape supply expectations long before harvest. Even small pattern shifts can influence price direction. Producers know this. Weather doesn't need to be extreme to matter. And in ag news, demand still in focus. Markets continue watching whether grain demand holds steady or softens, a key factor for price direction. Livestock supply tightness continues. Tight cattle supply support prices, but elevated levels increase sensitivity to demand changes. Energy stability helps, but long-term cost trends remain uncertain, keeping margin planning cautious. Calm markets don't always mean safe conditions. Sometimes the biggest pressure builds quietly. Grains are steady but tight, livestock is mixed, and crude is holding, leaving producers managing stability rather than clarity. If you watch daily, you'll start seeing a pattern forming, and that pattern often appears before the move does. What are you seeing locally right now? Are margins tightening, holding, or improving? This is Boots and Bushels. Thanks for watching.